Have you ever wondered how the stock market works? Well, think of it as a bustling marketplace, but instead of buying fruits and vegetables, you're trading shares of publicly listed companies. It's a vast global exchange where countless transactions happen every second. This vibrant marketplace plays a significant role in driving the world's economy, setting prices based on supply and demand. Now, you might wonder, how does one trade stocks in the marketplace? Trading stocks isn't as complex as it might seem. The first step to dip your toes into the stock market water is to open a brokerage account. Think of it as your getaway to the stock market, a platform that allows you to buy and sell stocks. Once you set up an account, you're ready to start trading. But how does it work? Well, when you decide to buy a stock, you place an order through your brokerage. This order then goes to the stock exchange, a marketplace where buyers and sellers meet. There are two main types of orders you can place. A market order is when you buy or sell stock at the best available price. Meanwhile, a limit order allows you to specify the price at which you want to buy or sell. Research plays a crucial role in trading. It's important to understand the companies you're investing in, its financial health, and the market trends. Informed decision-making can be the difference between a successful trade and a not-so-successful one. But let's not forget, trading stocks isn't just about potential profit. There's also the risk of losing your investment. That's why it's important to have a balanced portfolio and to only invest money that you can afford to lose. Remember, trading stocks involves both potential profit and risks. Knowing when to buy and sell stock can make a significant difference in trading success. Let's unpack some basic strategies. A golden rule in trading is to buy low and sell high. This means purchasing stocks when the prices are down and selling them later when the prices have risen. But how do you know when this will happen? Identifying market trends, assessing company performance, and monitoring economic indicators can offer you some clues. Marketing trends can give an overview of stock behavior over time. Is the stock's value generally rising, falling, or staying the same? Company performance is another key factor. If a company is doing well, its stock's value is likely to increase. Economic indicators like inflation rates and employee statistics can also influence stock prices. These strategies can guide you, but remember, there's no guarantee to fully predict the stock market. Not all trades are created equal. Let's take a moment to consider this. Picture yourself buying shares in a promising tech startup. Soon after, their new product becomes a smash hit and their stock value skyrockets. You've just made a good trade. But what if instead you sold those shares right before the product launch? You'd be kicking yourself, right? That's a classic example of a bad trade. In the stock market, patience is key. It's all about playing the long game. Remember, stocks are not lottery tickets. It's not about instant gratification. It's about watching market trends, understanding the ins and outs of the company, and making informed decisions. It's also about learning from your mistakes. Sure, everyone makes bad trades. It's part of the game. But the key takeaway here is not to dwell on these missteps. Instead, use them as learning opportunities. While it's impossible to avoid bad trades entirely, learning from them can improve your trading skills. The stock market has a long and fascinating history. The journey starts in the 17th century with the establishment of the world's first stock exchange in Amsterdam. This was where the Dutch East India Company, the first publicly traded company, issued shares to raise capital, setting the blueprint for modern corporations. Fast forward to the late 18th century, the New York Stock Exchange was born, growing to become the epicenter of global finance. However, it wasn't always smooth sailing. The Wall Street crash of 1929 helped trigger the Great Depression, and this serves as a reminder of the market's unsteadiness. Post-war, the market began to trend a steady growth, with occasional hiccups known as bear markets. The advent of technology in the late 20th century revolutionized trading, making it more accessible to the masses. Understanding the past can give insight to the present and future stock market. This video delved into the market fundamentals, learn the process of trading stocks, and discover when the best to buy and sell. This video also looked at examples of good and bad trades, teaching that every decision counts. This video even took a brief journey through the stock market's history, understanding how it shaped the present. With this knowledge, you are better equipped to navigate the exciting world of stock trading. Thank you so much for watching this video. I hope you learned something. Goodbye!